Welcome to CoreLogic's housing market update for December 2022, brought to you by onthehouse.com.au. CoreLogic's National Home Value Index moved through a seventh month of decline last month, with values dropping 1%. That takes values 7%, or approximately $53,400, below April's peak. The decline comes after national housing values surged almost 29% through the recent upswing, adding roughly $171,000 to the value of the average dwelling. In good news for homeowners, although values are still trending lower, the rate of decline has been consistently moderating since the national index dropped by 1.6% in August. The easing in the rate of decline is mostly emanating out of Sydney and Melbourne, but it's also evident across many of the smaller capitals and most of the regional markets. 3 months ago, Sydney housing values were falling at the monthly rate of 2.3%. That's now reduced by a full percentage point to a decline of 1.3% in November. In July, Melbourne home values were down 1.5% over the month, with the monthly decline almost halving last month to 0.8%. The rate of decline has also eased across the ACT and is no longer accelerating in Brisbane. Most of the broad rest of state markets have also seen the pace of declines decelerate. Potentially, we're seeing the initial uncertainty around buying in a higher interest rate environment wearing off, while persistently low advertised stock levels have also contributed to this trend towards smaller value falls. However, it's fair to say housing risk remains skewed to the downside, while interest rates are still rising and household balance sheets are more thinly stretched. There is still the possibility the pace of declines could re-accelerate, especially if the current rate hiking cycle persists longer than expected. Next year will be a particular test of serviceability and housing market stability as the surge in fixed-rate loans secured in 2020 and 2021 start to expire. Across the broad housing types, unit markets have continued a run of relative resilience. In November, capital city unit values were down 0.6%, while house values declined at twice the pace, with a 1.2% drop. This trend has been seen throughout the downturn to date, with capital city unit values down 4.7% from the recent peak, while house values are down 8.4%. Every capital city except Hobart is recording a more resilient outcome for unit values relative to houses. This trend can at least partially be attributed to the more moderate gains recorded during the upswing, but probably also reflects the unit sector's more affordable price points at a time when borrowing capacity has reduced. Sydney remains the only city where housing values have fallen by more than 10% from their peak. Through the upswing, Sydney housing values increased by 27.7% before topping out in January. Despite the sharp 11.4% fall in values through the downturn to date, Sydney home values remain 10.3% above pre-COVID levels back in March of 2020. Due to a weaker upswing, Melbourne housing values are only 2.8% above where they were at the onset of COVID. Most of the other capital cities and broad rest of state regions are still recording dwelling values at least 25% above March 2020 levels. The trend in new listings added to the housing market drifted higher through November. However, this year's spring listing season has been quite mild. Over the 4 weeks ending November 27th, the flow of new capital city listings was about 31% lower than a year ago and 14% below the previous 5-year average. The lower than normal number of new listings coming onto the market has helped to keep total advertised stock levels below average as well. Across the capitals, total listings haven't been this low at this time of the year since 2010, and regional listings are at the lowest level since 2007. Such low stock levels are likely to be a key factor offsetting the negative impact of higher interest rates and low consumer sentiment. While advertised supply levels are lower than normal, so too is housing demand. Capital city home sales were estimated to be 23% lower than a year ago and almost 2% below the previous 5-year average over the 3 months to November. Given the trend in new listings has recently moved through a seasonal peak, we are likely to see activity from both a listings and a buying perspective record a sharper decline around the middle of December through to late January as the festive season disrupts the home buying and selling process. Perth housing values were stable in November, breaking a 3-month trend where housing values were edging lower. Along with Darwin, Perth was the only capital city to avoid a decline in values through the month. The number of homes sold also held firm relative to last year, bucking the broader trend towards less transaction activity across the larger capitals. The resilience of the Perth market could be attributed to the relative affordability of housing, along with strong local economic conditions, tight labour markets, and positive migration rates. Perth is recording the lowest median house value of any capital city and the second lowest median unit value after Darwin. The outlook for the housing market remains skewed to the downside, with expectations for further falls in home values, at least until interest rates find a ceiling. The trajectory of interest rates is the most important factor for housing market conditions. The RBA has settled into a more moderate cadence of rate hikes, moving from 50 basis point increases in the cash rate to 25 basis points in October and November. Although the RBA could revert back to a more aggressive policy stance, there is a good chance Australian interest rates will peak in the first half of 2023, if not the first quarter. A cash rate of 3.1% takes the rate hiking cycle 300 basis points higher than the emergency lows recorded before the tightening cycle began on May 3rd. Importantly, this takes interest rates to the limit of mortgage serviceability assessments that recent borrowers were tested on. To date, bank reporting shows mortgage arrears have held around record lows, but 90-day arrears rates are likely to rise over time given the higher interest rate setting and elevated inflation against a backdrop of record levels of household indebtedness. If interest rates move materially beyond 3.1%, it's reasonable to expect a more substantial rise in mortgage distress, especially when considering the high cost of living pressures. A lift in fixed mortgage rate refinancing activity from the second quarter of next year adds to the downside risk of higher mortgage distress. The RBA recently estimated around 35% of outstanding housing credit was on fixed-term rates, which is higher than the historic average of around 20%. Furthermore, the RBA expects about two-thirds of these loan terms will expire by the end of 2023, with borrowers facing a 3 to 4 percentage point rise in their mortgage rate. While mortgage arrears are likely to progressively rise from record lows, the risk of a material lift in defaults remains small. Tight labour markets will be a key safety net helping to keep a lid on defaults. The unemployment rate, recorded at a generational low of 3.4% in October, is set to rise in 2023, but not to above average levels. Forecasts from Treasury and the RBA, along with the private sector, generally put unemployment around the mid-4% range in 2024, which is still well below the 10-year average of 5.5%. Household savings and a history of higher than required mortgage repayments should also provide a buffer to higher mortgage rates and cost of living pressures. The RBA recently noted the median variable mortgage rate borrower had enough in their offset or redraw accounts to cover 20 months of mortgage repayments as of August. Persistently low inventory is helping to balance out the slump in housing demand. With advertised stock levels still well below average across most markets, there's no evidence of an oversupply of homes available to purchase. A rise in advertised stock levels would be a warning sign for a re-acceleration in the downturn, but this is looking unlikely, at least in the near term. As housing values trend lower and incomes rise, some measures of housing affordability are easing. Across the combined capitals, the median dwelling value to income ratio reduced from 8.4 in the March quarter to 7.9 in Q3. The number of years estimated to save a 20% deposit also trended lower, from 11.1 years in March to 10.6 years in September. An improvement in these metrics implies lower barriers to entry for first home buyers. The flip side to lower affordability barriers is worsening serviceability. The portion of household income required to service a new mortgage was already rising before interest rates moved higher from their record lows. With interest rates trending higher, the portion of median household income required to service a variable rate mortgage is back to the highest level since Q3 2008, when the cash rate was 7%. Well, that's a wrap for 2022. Our next monthly video update will be released in February next year. However, our December Home Value Index will be released on our website on Tuesday, the 4th of January. Thanks for tuning into all the property market twists and turns through the year. In the meantime, you can check out the research pages at CoreLogic.com.au for the latest news and insights. On behalf of CoreLogic, have a safe and fun festive season.